jump into that, I mean, I can show some futures charts after, but tonight on our Trading Topic Tuesday, we're kicking off. Last month we focused all on crypto, and we covered a bunch of good information there, how it started, where it's going, how to invest in it, how to get started, and how to open up a wallet. Today we're shifting gears with jumping back into trading. So we're gonna go dive into introduction to the futures market. You know, you hear me tossing the word around here and there, and some. This is gonna be a good refresher if you've already been trading it, or if this is gonna be a good introductory course or piece for you guys that if you can just start learning from the get-go. So I'm gonna be starting from the very beginning. Lots of good content I've prepared for you guys, and hopefully it's going to be of value. And if you have any questions, please put it down in the chat. For those who are going to be watching a replay, hit us up if you have any more questions. But from there, I'm going to be jumping into my screen share. Cool. Intro to the futures market. So we jumping off, I like to share a cool quote from Mr. Ed Sakota. For those who don't know, he's one of the legendary traders back in the day. He's still actively trading today, and he's one of the greats that people look up to. You know, he's a pioneer in the commodity market. He quotes, "Win or lose, everyone gets what they want out of the market. Some people seem to like to lose, so they win by losing money." Now, these are just one of his many quotes where he keeps it so simple, but it's so what do you call impactful, and it has like levels to it. You know, it might fly by tonight, but later you're gonna be sitting and be like, damn, that's what he meant, you know. So yeah, Ed Sakota, market wizard, lots of good stuff there. So let's just kick it off with some basic info on the history of futures, right? Futures market. So the earliest recognized futures trading exchange was in Japan with the rice exchange, Dojima Rice Exchange. It was established in the 1730s, dude. And the sole purpose was to trade rice futures, so the price of rice crops going forward in the future, right? And they're just trying to make sure their prices are being lined up. And so it made its way to the Chicago Board of Trade, CBOT. They opened up in 1848, quite a while. But it wasn't until 1970 where it really just expanded, you know, the different exchanges. So we got the CME, Chicago Mercantile Exchange, and then the New York Stock Exchange. So the CME started offering currency futures, so these futures contracts based off of the euro, the pound, the Australian dollar. And then New York Stock Exchange offered the different ones like trading T-bonds, trading oil. And so later futures metals, so gold, silver, palladium, platinum, and then the index futures like the S&P, the Dow, those were later added to catch up because it's just been an expanding market. And so a futures contract, will break it down. This is a key thing to like just start our information on, right? When you trade, you're like, what are we exactly trading in the futures market? We have your crypto market where you're trading cryptocurrency for either the USD, like a pair, right? Bitcoin versus USD, Shiba coin versus Ethereum, like so. And then you have the stock exchange where you're purchasing stock of AT&T, Apple, Tesla, and you're trading that. You're trading your piece of stock in the market. Futures contract, it's a distinct forward contract that it's a legally binding agreement to either buy or sell a standardized asset on a specific date during a specific month. Okay, standardized asset, just this is something to just highlight. Standardized asset during a specific date or month. And a lot of the main exchanges that currently trade futures is through the CBOE, ICE, and New York Stock Exchange. And I think there's other ones. The Euro has their own. So this is global. You can trade futures global. They have futures contracts for all the different markets in London, Japan, Australia, US. And so a futures contract, what it does, it represents a underlying asset, right? So for example, I have listed crude oil. And the crude oil, one contract represents 1,000 barrels. Okay, so one contract of crude oil represents 1,000 barrels of oil. And so you have remember we're going off of the specific date during a specific month the contract expires, because there's a start of the contract and then there's an expiration date of the contract. So if I'm trying to buy this one contract, it represents 1,000 barrels of oil, and I'm expecting it to be delivered on the 17th or 2017 December, so if my contract was to expire and I'm still holding that contract, what's owed to me will be the 1,000 barrels to be delivered. They're gonna deliver me 1,000 barrels of oil. Now, what the heck am I gonna do with that? I have no clue. But I will have to fulfill my duty and pay the exchange for that contract. Okay, so that's on the commodity side. We have the contract for the currency market. We have the dollar value, the US dollar value of $100,000. So one contract, so that we'll go into the different coding and stuff. So one Australian currency contract represents $100,000 in Australian dollars versus the value of $100,000 in US dollars. So there, I don't want to dive in too deep. It's going to be easier to see once I pull up the charts and stuff. So it's just kind of giving you guys an idea of like, okay, this contract represents a standardized asset. All right. And so there's different codings for the contract. So meaning, like with the pairs, right, you're trading Euro USD, right? You have the 3 digits for that. And the Bitcoin's BTC/USD. The futures contracts has these different codes where we have the first 2 letters are usually representing the asset. So you have like the S&P is represented as ES, and then you have the third digit is going to be a letter, right? So right now in the indice market, we're going to be seeing these H contracts, right? And so let me back out of this. So let's look at my bottom right of my screen here. You guys can see that, right? So we got the ES.
Yeah, we can.
H2, NQH2, YMH2. These guys represent a different market or a different contract. So E-mini NASDAQ 100. So you have the NQH2. So going back to my these letters and numbers all have meanings. So the first 2 letters is of the asset, right? So NASDAQ is the ticker is NQ. S&P ticker is ES. Russell is RTY. And then the Dow is YM. Don't ask me how they got it. All right, that's just the way. And then the third, the H, all of these have H's. That means they're gonna expire. I there's a specific date in March. They're gonna expire in March, okay? And then the 2 means the year, so 2022, okay? And so I can type in, like, we'll go with YM. You see how this drop down has YMH2, YMM2, YMU2. So these are the forward contracts that's not currently, like, that's not where all the action is yet. Right now all the action is still on the H contracts. But if we pull up a M2, you want to look at the volume traded. See this? Total volume trade is 43 compared to 13,866. Okay, so that means, yes, this is a forward contract. It's not going to expire anytime soon. All the action is here, so you do eventually just want to stick with the more active contracts. This is, for those wondering, this is a Tradeovate platform, online platform. It's a trading platform. I like it. It's simple. It's pretty free flowing, and you can access it as long as you have internet. So going back to my share screen, where is it? So we got the trading codes, and each trading code, it represents the dates of when the contract will expire. So we're in the futures contract, we have a standardized contract. It represents an asset, and then the asset is going to be delivered on a certain date, which is all that. So the contracts, they have expirations, okay? Now this is a key thing to just understand when you're going to this. You cannot buy and hold these contracts and hold it forever like stocks, right? You don't expire, the stock doesn't expire unless the company goes out of business or they close it, right? So these futures contracts, you're gonna have to pay attention to when they have what their expiration date is, and they're either gonna expire or people will take it and settle on it, right? They're gonna continue to hold the contract. Or the third thing that could happen is you roll it over. So if I have the H contract, the March contract right now, and I know that tomorrow it's gonna expire, I'm gonna close that position, go into the next contract date, and then open a new position there, and that's what they call rollover. So you don't want, as a trader, you don't want to take delivery of these things. And so they can end up in usually 2 different ways: settlement or rollover. And so we're going to be rolling over. And so the tick movement on the futures contracts, this is a cool thing. So we have a E-mini S&P contract, and this is something, it's like 1 tick is like a pip in the Forex, right? So it's just the nominal value, the price moves, yeah. And so the price, the S&P price, moves in quarters, okay? And so it moves in quarters. So this specific contract, 1 point of the S&P, there's 4 quarters and 1 point. And so 1 point equals $50. So all they're doing is dividing, or they're multiplying the 2, and they get $12.50 per tick. And so each movement equals $12.50. So if I was to show what it looks like on the trading view, let's go to the S&P. So on the right here, you have your DOM. So you can see 43.22.00, 43.22, 2.25, 0.50, and so on. And so say I bought, so this is a practice account, so let me just do this, right? I'll buy market.
Order filled.
Well, so I'll buy market, and you want to look that I'm down 2 ticks, and then it goes, oh, now it's break even, down to, so it's 12.50 each tick, you know. And so that's how this market will move, and specifically on the S&P E-mini or the ES, many different names. And so say my target's going to be 2 ticks. I put a sell stop here, so bought at point 0, and then 1 tick, 2 tick, 3 tick, and that should be $36, I believe. 3 tick, and then because the 4th tick is going to be $50, right? So now I'm positive 12.50 because price is 1 tick up.
Order filled.
Oh, there you go. So I just got 3 ticks. So that was $60 or whatever. Right. Oh, 37. Sorry, 37.50. That's 3 ticks. So on the S&P, that's the price. Now you can't go a fraction of a contract when you're trading that specific thing. It has to be 1 contract, 2 contract, 3 contract, all the way up. You can't go half of that because $12 per tick, that can be intimidating, man. Right? It's like trading 12 lot. So it's a lot. You gotta really understand your risk there, um, and you can't really have a big stop unless your actual total capital, you can withstand that. You know what I mean? So $50 a tick. Each market has different contract specs. So this is specifically S&P 500, the E mini, also known as the ES. That's what that looks like. So when it comes to trading these futures markets, you're gonna need margin. And to wrap up margin, it's just a good faith deposit for between you and the broker. And the broker is like, okay, you want me to go execute your trades for you. You're gonna need to hold X amount in your account in order for you to hold 1 contract at the S&P 500. Or if you want to trade corn, you're gonna need to hold X amount of dollars in your account, not touch it. You can't touch it, so you can hold 1 contract of corn. Okay, so you have 2 different margins. You have intraday margin and you have overnight margin. And I can show you what it looks like in the next slide. But intraday margin, just to um, give a heads up, intraday margin will naturally be lower than overnight margin because the risk while trading intraday, and to clarify what intraday means, you're going to be opening your position at the beginning of the trading day, which is like the New York Stock Exchange, and then be closing it at 3:15 or no 3:45 Central Standard Time, 15 minutes before it closes. Because if you don't close it, then the broker is going to automatically adjust your position, and then they're going to require a bigger margin, because if you want to hold your positions overnight, you're going to need more margin because the risk is there. That makes sense. Any questions so far, dude? I don't want to go over. Hope this is you guys are following.
Yeah, man. I mean, as you're going over this, I'm like, man, I'm gonna have to like rewatch this because I'm following it and I get
Yeah,
it, but like to really for it to soak into, I need that repetitive playback. But no, you're good, man.
yeah.
It's I'm following. Yeah,
Good, good. All right, so the next, so for an
I know
example,
Sandy's good too.
yeah, I'll give you some examples of what margin looks like. Okay, so we'll just stick with um, at the top slash 6A. Okay, this is your currency contract. This is your futures contract for the Australian dollar. Okay, and then if you look towards the right, you're gonna see a tick size.
Sorry, what is ETH? Like ETH?
Ethereum, ETH. That's
So
Ethereum futures contract. You're looking
Like
at the
it's
bottom.
odd, yeah. So it's odd dollar slash Ethereum.
Oh, you're looking at the ETH over here. I do not. I am not clear on what that actually
Uh,
means. That's a
uh,
good point. I'll go find that out. But
yeah, no
it's
problem.
not it's not a pair. I mean, it's not comparing it to ETH. It's
I
just
see, I see. Okay.
it's yeah. So let's look at yeah. Just look at the Australian dollar futures. I gotta go figure what that is. Good question. Tick size is 4 zeros and then point 0.5. So if we look at price, let me go pull up price of the 6A. Let me switch my screen real quick. Okay, we'll zoom into like a 5 minute. And then so this is Australian dollar, pretty much. If you compare the price movement, it's pretty much reflecting almost the same spot price action. So on the right side, remember we're saying that the tick value, tick size is 0.00005, right? So one tick equals $5. So like the S&P, it was $12 per tick, right? So if you look over here on the right, I have it's trading at 0.72665. One tick from that is 0.72670. So the difference is that decimal, 5, right? And it goes by fives, which is pretty simple. So one tick, two tick, three tick, four tick, and each tick represents $5 in profit or $5 in loss by price movement. Okay? And then if you just look at the chart, it's reflecting almost the same. Like, let me just compare it to the odd dollar. We'll go 5 minute. So it's essentially the same, you know. So on the right we have odd dollar trading at 0.7265, and then there's a small difference of the futures 0.7267, you know. So it's almost the same. And so if you're analyzing odd dollar on the future, I mean the forex side, you're gonna see almost the same price action there. So back to like the tick size, you know. So usually if you enter a trade with on the forex side, you're one you go enter your lot size, right? And it can range from like 50 cents a pip or whatever, and the price moves up. For this specific market, the one contract you're trading is $5 a tick. Two contracts will be $10 a tick. Three contracts, $15 a tick. Right? And so up here on the when you're making your order, you can adjust here. You can go 5, 3, 5, 10, 20 contracts. That's what that means when you hear these traders say, "Oh yeah, I'm buying, I'm trading 10 contracts, 20 contracts." And so their cost per tick does go up. Now, when you do that, your margin does go up. So let me get back to here, the margin. Let me just exit out of here. Go
So
back.
contracts is basically lot size, yeah. In the forex market.
Yes and no. The contract, you got to take in mind, it's kind of, right? But you got to take in mind that one contract for the odd dollar futures represents $5 a tick. So you got to take that into consideration when you're purchasing more than one contract. Oh, Raja Eleni's logging in. Um, so yeah, that's what you got to take into consideration compared to the lot size. It's like how much value, tick value, can you trade or can you withstand? So the initial margin to hold one Australian dollar futures contract is $1,595. Now this is a full margin where if you're holding it overnight, if you're trading intraday, I believe it's less. And margins, I've seen throughout the trading times where, like especially in 2020, my broker would email everyone, be like, hey, because of the volatility, we're raising our margin higher. So if you want to hold this Australian contract, then you're gonna need 3 grand compared to like 1,500. So that's kind of what happened, especially with the S&P 500. So if you look down on the bottom half, you got the /ES one. If you want to hold um, margin, that you need 16 grand in your account to hold one contract. And if you go below that, if your account drops to 15 grand, you're you're gonna hit margin call. That's what they call margin call. Yeah, your broker is gonna close you out, be like, yo, you don't got enough money in your account to hold this contract. Sorry. You know. So look, if you want to look at the Bitcoin futures, dude, you need $110,000 to hold one contract of Bitcoin futures, because it's just the way that the contract was made, and it's standardized. So if you go to, this is off of Thinkorswim, TD Ameritrade. If you go to all the different futures brokers, they should have a very similar setup. The tick value will be the same. The tick size is going to be the same, but the margin may be slightly different depending on the broker and what kind of activity. So, this is just a snapshot of all the different futures markets that's available to trade. You got lean hog, feeder cattle, copper, coffee futures, orange futures. There's almost a futures with everything, which is why I like trading futures, because you have access to trade a lot of different things. With Forex, you're stuck with the Forex pairs. With crypto, you're stuck with crypto. The stocks, you're stuck with trading stocks. Futures, you could kind of just bounce in and out of different markets. Be like, oh, Forex market is pumping. Let me go jump on the contract. You got commodities pumping. Let's go jump. Let's go trade commodities. You know. And so, there are. I gotta show. Let me see. Let me bounce out of this. So if the Australian dollar, another thing to take into consideration for us retail smaller guys, if I want to trade Australian dollar, there is a micro contract where the margin is a fraction of what's needed. So remember, we needed $1,500 to hold one contract. The micro contracts, you only need $159 to hold one contract overnight. And instead of the tick $5 a tick, it's $1 a tick. So a lot of it's risk management, or keeping our risk in check, and allowing us to be able to trade these active markets while not going bust. You know what I mean? And so same for the the S&P, instead of $12 a tick, because that is a lot, they have this micro S&P contract. It just came out last year, so it's a good alternative market. The exchange listen to the traders and be like, yo, all right guys, let's go introduce this new contract. Drastically big difference. That way we can scale up. We can trade 5 contracts and then it would still be less risk compared to one S&P ES contract. You know what I mean? So we have micro gold futures, micro Nasdaq, micro Swiss franc. So those are different things out there. Micro, even a micro Bitcoin futures, instead of 100 grand to hold, you need 2,200, right? So say I had like a $10,000 account. My max positions for this, if I'm trading micro Bitcoin futures, if I have a $10,000 account, I only can hold about 4 contracts, right? Um, because it's $22 margin per contract. So I don't know what the math is, bro. Is that 8,800 roughly if I trade 4 contracts? So that means I have to hold. I have a $10,000 account. My margin's 8,800, and then I'm holding those 4 contracts. Let the price fluctuate, and that'll keep you from going to margin call from your broker. You know what I mean? Good, good, good. So that's. Let me go back to what we got here. That was margin. That was a main. One of the main things I wanted to discuss was the margin. So it kind of gives you an understanding of, okay, if I'm trading futures, I need to understand if I want to buy 1 contract, I need to have X amount in my account. Then I could hold that contract. Plus, I have to consider price fluctuation, my stop loss, right? And so, key takeaways with the futures markets, this is just the very beginning. We're scratching the surface, you know? Like, there will be a lots of, hopefully, more down the line where we can be talking about futures, breaking it down, going more in depth. There's a lot. There's a lot to take in, you know, and ask questions. Rewatch this. This is going to be recorded. So, just to wrap up the futures markets, there are 24/5. So, well, actually 23 hours 5. That was a typo. Okay, because they close for about an hour, about 11 a.m. our time, 11:30 a.m. our time. They close for about an hour, and then they reopen for the overnight markets. 5 days a week, they're available to trade. They're active and liquid, very active, very active. You can always get in and out of trades. You should, with a reputable broker, you should be able to get in and out of your positions. They're standardized contracts that protects both the buyer and seller. So no matter what side you're on with these futures contracts, you know what you're getting. All right, because like it's a standard thing. Everyone knows if you go to McDonald's, you get a Big Mac over here, and then you go to uh, another McDonald's in East Coast, you're gonna get the same Big Mac, right? Number 3. I don't know. Is that the menu number? So, standardized contracts. You can take advantage of the up and down markets. So this is a big advantage this has compared to stocks. Stocks, you only can purchase stocks, right? But the market does move up and down. And when you are trading futures, you don't necessarily have to own 1 contract of S&P or 1 contract of odd dollar in order for you to go short. So it does offer that characteristic like the Forex market where we can just go short anytime or buy at any time. It's regulated and monitored by the proper departments, so you don't gotta worry about it, right? You want to make sure your broker, you got to do your due diligence, make sure the broker is what do you call, not accredited, what do you call it? It'll come to mind, but yeah, regulated. Hello. No,
Regulated.
the brokers are regulated, right?
Yeah.
I wrote that. Hello. Yeah, and there's a lot of opportunities trading in the futures markets. Lots of opportunities there. Lots of stuff. Um, yeah, I started I started to learn how to trade with futures markets. So
That's the
therefore,
first market you started off with.
pretty much, dude.
Can you go over with us a recent futures trade you've taken?
Yeah, yeah. You know what? Let me go pull up my screen. Like actually, so this is a practice account I have going on. Let me back on here. Um, let's got the Dow. Got into this market after for the overnight session. So after when did it open? Like 1:30 p.m. our time. So on the right side we have our DOM, which I like trading, and it just breaks it down because so like this Dow it moves one tick equals 1 point. It's pretty straightforward. And then if you look at up here where I have my mouse at, it says position. I have two contracts for average purchase price of 33,340, and then right now I'm 166 ticks in profit. That 166 ticks equals $840. Okay? And
Nice.
because this particular market, each tick is $5. So I got two contracts that equals $10 per tick. Now, it's quite a bit because this market is very active, right? So like, let me go break down what I saw. Let's zoom into my intraday. Let's see this. Yeah, just move my screen. Sorry. Okay, so price was moving down. We hit a previous high of like 34,000, and price rejected it, right? And so this is a 1600 tick chart. This is like an intraday chart. Price rejected it, popped up again, went down, and then it started consolidating, and I saw it broke a previous high. And so my blue line is where I got in initially. My first entry, where did I get in? Doesn't even say. I probably got in on the pullback. So I saw these two pullbacks right here. So here and here, and I probably got in at 33,300 ish. Price popped up, pulled back again, so I added a second position. So my average buy will be 33,340, and now price is at the orange line where it's up 140 ticks. And so do I even have my stop? Guys, gotta everyone put one stop in. So my stop, now that I have two contracts, I have to really take that into consideration, knowing that each tick is $10. Okay, so this market can move sharply against me. So I'll put a previous stop at the previous low. I'll do a stop. So that's about 40 points. So I know
That low tick.
if you notice that like over here on the left side, it's kind of like incomplete candles. That means this current contract hasn't been traded really active. Remember how I showed you on the bottom it was like 43 volume. So when this contract started to be traded, that's when you start to see these price move. And so when you're on the incorrect contract at the wrong time, that's what you'll see. You'll see like this inactive movement. So that's something to see. So yeah, this is a daily chart. If I go in, so we made a high, lower high, higher low. We made a new low, but we had a big rejection, right? So this is just strictly technicals, price action. We had this nice green doji here. Price really tried to go down. The sellers tried to really bring it down, but it ended up closing at this nice point here. And so follow that was a big engulfing green bar. And then price tried to make its second attempt to go low, but it got halted. And we held our ground. The buyers held their ground at this level. And so I was like, okay, I see that, and I've been seeing, I this is one of the setups I like seeing and trading, and so whenever I see that, I'm like, okay, and this is over 1, 2, 3, 4, 5 days of price action, so a
Will you
lot
be
of
looking to enter more contracts on this one?
as price moves up, I will add more contracts.
Nice.
Yeah, yeah,
Yeah, I like that low test reversal right there.
yeah. I mean, you see that all the time,
Yep.
you know.
Great technical tool to use to identify.
Yeah, man. Yeah. So I mean, like, going back to the futures market, lots of different things. It's a lot to take in, but it's a really good market to understand because you can trade lots of stuff, dude. You can take advantage of the moves, man. If you guys have any questions, dude, feel free to ask.
Hey Glenn, so is futures and Forex almost the same?
Two different two different markets technically, but like I was mentioning in the futures market, you can trade certain currency or forex contracts. You know what I mean? So you
Kind of
can
like
take
Forex falls in futures, whereas futures can't really fall under Forex. You know what I mean? Like I
correct.
can't just go with a Wanda and trade futures, whereas like you could with your broker trade Forex pairs and future
Yeah. So
markets, which is
going back
pretty
going back to the what's
flexible.
available. There's only 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 pairs, and so these 10 currency contracts, they're all compared to the US dollar. And so they're very correlated, you know what I mean? Like,
Mm.
yes, you can, like, if just think about, okay, Swiss franc, that's going to be USD CHF. New Zealand dollar, NZD USD. Mexican
How about the
peso.
Russian ruble?
Ruble. No, I don't think it's on here. No. They might, Let's see. See? Holy,
Russian, right?
get 'em. Let me see. H22. 6R. Oh, no can. Sometimes you can't even get data.
Uh,
Yeah. Maybe I think they halted, right? Halted trading?
uh, Russia did, yeah, for 2 days in a row. But
Oh,
if you
never
get,
mind.
there's still some movement.
Yeah, let's see here. Oh, right here. This is
Oh,
Russian ruble. Action.
yowzas.
Yeah. So you can trade it. What is the margin for this thing? It doesn't show. So if you really look, but the thing is, you got to take into consideration when you're trading these more exotic pair currency, the volume is going to be very low. And so like even with the Canadian dollar, sometimes I notice if you're watching price action, like right now, it's pretty slow. Pretty slow. There's not much movement. Like it looks like in the past few hours, we've only traded within these small amount of ticks right here. Not much movement. So you got to look at that, and then over time, just looking at these different markets, you're gonna notice these small different things. So like look at the Euro USD, compare like the activity. It's
Oh
more
wow, yeah,
more volume, yeah.
one of the most traded pairs.
Yeah, so this is a good market to trade. The yen pair. Let me zoom in a little bit, maybe. The yen pair can get active. British pound. So I mean, those are things. So yeah, you can trade forex, but you're very limited to the USD pairs. The different futures brokers. That's yeah. If you're googling, just go futures brokers. Ninja Trader, TD Ameritrade, there's Thinkorswim. Um, Gain Capital. Who's the other ones? Interactive Brokers. Those are reputable companies. They all have different requirements when you open up a futures account. Some of them it's as low as I think they just require like 1,500 to open up a futures account. Compared to like the Forex, you just need $100. So you know, and so the entry isn't too bad. Some companies they require like 25 grand for you to open up a futures account. You know, and so those are things to consider. I'll put in more links later on the different platforms or brokers, futures brokers. But yeah. Yeah. We're coming up on 8 o'clock, guys. I mean, if you guys have any other questions, man, thanks for coming on, spending some time learning. I hope you guys gained some good stuff tonight.
I did for sure.
Yeah. But next week we're gonna be jumping back to Forex. Yeah.
I believe so, yeah.
Forex, bro. Forex.
It's good stuff. I'm gonna watch this again.
Roger.
Try to get more into the futures, man. Sounds good.
Oh yeah.
Nice, Drew.
Oh, yeah.
Thanks for joining in, man.
Thanks, guys. Thanks for joining in.
Thank you, guys. Mahalo. Be safe, guys.